I've been buying them recently. If you believe that the gold price is going higher, in other words, if you believe that you can maintain $4,200, on the metric that I use to buy these stocks, which is the net present value of future cash flows relative to enterprise value today, these stocks are cheaper than they were at half the price. The move in the gold price from $3,000 to $4,200, yes, it's a $1,200 move on a $4,000 base, which is a 25% move or something like that. But it's all margin. If these guys were breaking even, totally breaking even, including cost of capital at $2,000, they had a $1,000 an ounce margin at $3,000. They have a $2,000 an ounce margin today, which is to say their margin has doubled while at the same time their reserves and their production has increased. If you believe the gold price holds, these stocks are cheaper than they were when the stocks were selling for half the price. This is pretty compelling arithmetic from my point of view. I would note that since 1913, the year of the establishment of the U.S. Federal Reserve, the U.S. dollar has lost 97% of its purchasing power. So the idea that it will lose 3/4 of the remaining 3% doesn't seem outlandish when you look at history. Particularly when you look at that history and you look at our on-balance sheet and off-balance sheet debt and deficits as a percentage of gross domestic product, or better yet, as a function of gross outputs. The circumstances that we have in place today are more egregious circumstances, arithmetically, than have occurred during a century-long period, better than a century-long period, where the purchasing power of the dollar has been declined by 97%. Let's look at what would it take to reverse that decline, just for fun. That's how you test a thesis, right? To begin with, you'd need a balanced budget. You would need to erase a $2.5 trillion on-balance sheet deficit in the United States. Fat chance. You would need, secondly, to figure out how you were going to deal with the $38 trillion in gross encumbrances. $36 trillion net. In other words, how you're going to pay off the bondholders, particularly because $9 trillion of that debt needs to be refinanced in the next 12 months. Then, how do you deal with $120 trillion in net present value of entitlements? Medicare, Medicaid, Social Security, military pensions, federal pensions. How do you deal with that? Are you honest? Do you send a letter to some old codger like Rick Rule and say, yes, you've paid into Social Security for 60 years, but no, you're not going to get any money? Old guys vote. That outcome looks problematic to me. What I think we do is we do what we did in the decade of the 1970s. You're too young to know this, but let me tell you what we did. We'd fought 2 wars in the 60s. We fought the war on poverty, which we lost, and we fought the war in Vietnam, which we lost. And what we had left over was a bunch of debt and deficits. And it was politically unpalatable to say to various creditors of ours, either bondholders or entitlement beneficiaries, that they weren't going to get paid. So what we did is we honored the nominal value of our obligations while inflating away the net present value of the obligations. We reduced the purchasing power of our obligations by 75% in 10 years. My suspicion is that passes prologue. If you did that, you would reduce the real value of U.S. obligations, the purchasing power of U.S. obligations, from a gross total of, $155 trillion down to some number like $35 or $40 trillion. That's not such an ugly number. It's ugly for the people who are bondholders, and it's ugly for the people who rely on entitlements. But it seems to me to be the only arithmetic way out of this fiscal trap that we've put ourselves in. Of course, Mr. Trump says he's going to grow the economy out of this. Do you know that I've heard this out of every president in the United States since Eisenhower? You may not even know who Eisenhower was. He was so long ago as a president. The one who came closest was Reagan. Reagan, despite his mandate and despite his promises, did not reduce the size of the U.S. government. He only reduced the rate of growth. Reducing the rate of growth of government while at the same time crushing inflation with very high interest rates and taking a recession is what led to a boom that began in 1981 and really ended in 2022. I don't even know if we have the will to raise interest rates. Never mind reduce the size of growth of the U.S. government. If you look very recently, the Department of Government Efficiency didn't do anything. It was a tweet machine. So, your listeners will have to decide for yourself whether we can grow our way out of this dilemma, whether we can solve this fiscal dilemma some other way than the way we solved it in the 1970s. I'm not smart enough to know how we do that.
No, definitely. And Rick, this thesis that you outline here is basically exactly the thesis a lot of people on the internet have behind this debasement trade concept. And a trade, of course, implies getting out at some point, again, presumably for fiat. However, what you are outlining sounds like a structural shift, at least a very long-term trend of high inflation, money printing to get rid of these liabilities the government has. So should one view this as a trade, or should one view hard assets as something to own and save in?
I didn't sell my gold at the end of 1980 until I had to. Those very high interest rates took their toll on me. And although I didn't want to sell my gold, I had to sell my gold. That ended up being a good thing because the gold price fell fairly precipitously, but it wasn't voluntary. I'm not telling other people to do what to do necessarily. I save in gold and I maintain liquidity in US dollars. Those are two different things. And I will continue to save in gold until I see the reason to do so go away. It may be that technology is a powerful driver, particularly in the US. It may be that technology drives output efficiency so much that the United States in particular is able to rekindle economic growth despite the crowding out that occurs with government. It could be that we can do a lot more with a lot less. I'm not disinclined to that point of view. I don't subscribe to it because I'm not smart enough to understand it, but I certainly acknowledge it. If that occurred simultaneously with the inflating away of the U.S. government, with the net present value of U.S. government obligations, which is to say if the real value of the U.S. obligations fell by 3/4 and nominal inflation-adjusted taxes increased to the extent that the U.S. resumed the same level of solvency that it enjoyed in 1998, I would likely unwind the trade. But I don't regard it as a trade. I regard it as my own response to the political and social and economic circumstance that I exist in.
I appreciate that breakdown, Rick. I would love to talk about miners for a second. Of course, similar to the precious metals complex, they've had an outstanding year, if we're talking about precious metals miners, at least last year as well. If you're looking at some of the high quality names, the Agnico Eagles, the Wheaton Precious, the Franco Nevadas, for example, do you still see value in that space currently?
I've been buying them recently. If you believe that the gold price is going higher, in other words, if you believe that you can maintain $4,000, $4,200, on the metric that I use to buy these stocks, which is the net present value of future cash flows relative to enterprise value today, these stocks are cheaper than they were at half the price. The move in the gold price from $3,000 to $4,200, yes, it's a $1,200 move on a $4,000 base, which is a 25% move or something like that. But it's all margin. If these guys were breaking even, totally breaking even, including cost of capital at $2,000, they had a $1,000 an ounce margin at $3,000. They have a $2,000 an ounce margin today, which is to say their margin has doubled while at the same time their reserves and their production has increased. If you believe the gold price holds, these stocks are cheaper than they were when the stocks were selling for half the price. This is pretty compelling arithmetic from my point of view. Now, that's predicated on the fact that I believe that the gold price in nominal terms, I keep saying nominal, in US dollar terms, increases.
All right. And I presume it would be a very similar story if you were to go down the size trail a little bit towards the smaller producers.
My experience has been that precious metals bull markets follow a fairly predictable pace, which is to say the metal moved first. That happened. The best of the best moved next. That happened. Then you go to the best of the rest, the single asset producers, the developers. What happened in this bull market is that after the best of the best moved, the whole rest of the sector moved simultaneously. I've never seen money cascade down the sector so quickly as it's cascaded down the sector this time, to the extent that, on a relative basis, I think the juniors are overpriced relative to the seniors. That's not normally what happens at this stage in the market. It normally is that the smaller companies with more risk and less information distribution trade at substantial fundamental discounts to the major. Those discounts are either arbitraged away by professional speculators like me, or they're erased by the big guys with a lower cost of capital taking over the little guys. The explosion in penny dreadful financings that we saw in 2025 tells me that the market's starting to be back asswards, to the extent that in August of 2025, I actually sold 25% of my junior portfolio. I did that because by selling 25% of my portfolio, I could recoup all of the capital that I had invested in the sector since 2020 and pay the capital gains tax due on the sales. So I personally sold 25% of my upside and I eliminated my downside. Now, was that sale too early? Certainly. Would I have done better if I had waited till the last 10 days? Certainly. Do I care? Not a whit. I'm at the point of no concern now. I can afford to be very, 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 very patient. And it's worthy to note that I took the proceeds from that sale and I did two things. I bought a package of investments, including physical gold, Franco-Nevada, Wheaton Precious, and Agnico Eagle. In other words, I didn't diversify out of the sector. I diversified or reverse diversified from alpha to beta in the sector. I went to investment quality rather than speculation because of the mismatch in risk-adjusted pricing in the sector. I took the other half and I put it in the oil and gas business because, as you know, I love hate and oil and gas are hated.
Yeah, we'll definitely talk about oil and gas in just a second. I would love to talk about private placements for a second. Last time you mentioned that you really weren't participating in any. Of course, we are seeing a lot of financing in the space in the juniors with attractive full warrants, 2-year, 3-year warrants. Does that ever entice you to step in a little bit or just completely out of the financing currently?
I love those, but I don't buy junk. And where I'm seeing 2- and 3-year warrants, they are truly junk. You know, I'm not saying this is true all over the place, but everything I see companies where these salesmen are calling me up saying, listen, this thing has a $10 million pre-money market cap. It's dirt cheap. And I say to them, tell me what in the company is worth $10 million. If you liquidated all our assets on the street to a willing buyer, what could you get? Probably $500,000. So they're attracting money on a pre-money valuation that is 100% premium to what they're worth. And then they're throwing in a warrant at a higher price on an investment opportunity that features likely is not a 95% loss is of no particular interest to me. I'm not saying they won't go higher in a gold bull market. You know, in a gold bull market, the stratagem employed by most speculators has got a hunch, bet a bunch. So I'm not trying to say they won't go higher, but that's not a trap after 60 years that I'm going to fall into. Now, I have participated in some private placements where I wanted to get a bigger position. And it seemed to me that the only way I could get a bigger position was not to go into the market, but get it directly. I've done some other private placements where I wanted to show visible support in large measure. Some management teams I believed in. I learned that from my former mentor, Rule Sprott, who said sometimes you got to play team ball. You know, there's some people who deserve to win. You've won. To the extent that you have the ability to influence the game, you have an obligation to do it. And so I certainly feel that obligation. I've certainly done that. But in terms of participating in the length and breadth of the 2- and 3-year warrant transactions on the real flotsam and jetsam, the Me Too penny dreadfuls, you know, exploration companies run by butchers, bakers, candlestick makers, but no geologists, I haven't been a player.